Hey everybody, welcome back to the channel. So I got an update today. So one thing that happened today was that CNR actually failed to get the deal done with Kansas City Southern, and as a result, the stock price just shot up to over 150. So I've actually sold out of that position. I no longer own CNR. So that's one major piece of news. And I started a new position in Alibaba today. And from the CNR sale, I essentially just put it into different holdings. So we fortified we added a bit more to the banks, and we added more to Power Corp. I bought a bit more TELUS, bumping up that position as well. And then we added a few more to our income funds. So as you can see in the TFSA all time, we're up 11% so far for the year. And it's a little bit easier to see in the dividend portfolio rather than Wealthsimple itself. But so we increased our income to $32.58 monthly, which is nice. So because we sold CNR, because I no longer want to hold the company, just because that was one of my conditions for holding the company, was that they get this acquisition done. Since they didn't, I just put CNR back on my watch list. If I notice the stock price tumbles again, then it's probably just an early sign that they're in the running again to get the acquisition done. So I only wanted to keep it for that reason. So the best way to know when to sell a stock is just have a reason for why are you in the stock in the first place. I had my exit strategy here. So it was going long term if they did the acquisition, but it looks like it's just a quick flip for a nice 15% gain. So not too bad. We picked up more Power Corp. So I'm up to 11 shares of this. I still think this one is undervalued just because of the growth potential that Wealthsimple and Align Electric and all their other assets can provide. We added a few more fractionals to Scotia and TD, just get up our quarterly dividends for the banks. I added 2 more shares of TELUS since they're going ex-dividend on the 9th of September. So if you buy it before then, you will get the dividend that they're going to pay out in October. And we added a bit more to Smart Centers. I added one more to ENS, so a bit more Enbridge, a bit more income, dividend 15, and Canoe EIT. So I added to these positions mainly because we started a new position in Alibaba, and the main reason why is just because I think it's really cheap. I think it's really undervalued. Alibaba is just another an e-commerce giant straight out of China, and they are essentially, the Chinese Amazon. So they have these factories that are just full of robots that can just move things for them, and they're saving on workers and having to hire people, and they just have to maintain these robots, and they're just automating, and they can have even higher profit margins than Amazon. And just going by their revenue growth, they have insane growth potential. And I'm just going to compare it to Amazon. So you see 52, 28, 40. Amazon is 37, 20, 30. So Baba is growing at a faster rate than Amazon. It trades at about a 20 PE. $478 billion market cap. Just to look at their revenue, in the last 12 months, they've made $769 billion in revenue. So their revenue is double their market cap. That's pretty crazy if you ask me. And yeah, they have great financials, just growing revenues, excellent cash flows that are growing, amazing balance sheet. They have 3 times as many assets as liabilities. They have tons of cash, lots of growth potential. The main reason I think this stock just took a tumble is just because there's a lot of negative sentiment about China in general and the fear over what they're doing with big tech. So as you can see, a year ago it traded over 309, and now it's trading at 173 a share. I think that this is just a really good opportunity to get a fantastic, high-growing company at a very good price. So I think that this one's worth the risk. I'm going to basically just ignore the news and the sentiment about China and just focus on the company instead of the news, because that's just noise at the end of the day. And, investors can get really emotional and just be very impulsive with their buying and selling decisions based off of like one earnings report or just negative news of any kind. So that's something that you definitely want to know why the heck you're buying a business. And so if there's a negative article about it, you can critically look at it. As long as you understand the business, you know that the piece of news is not permanently destructive for the company, like it's going to bring them to an end, and it's just a temporary setback, then yeah, you can just buy the dip essentially once the price stumbles and people sell out of it. And just comparing it to Amazon has a 60 PE, so you're paying like triple the price for Amazon, and their growth rate is lower than Alibaba. So that's one reason why I decided to take the chance. So got just the one share to start, and I know this one is going to be a volatile holding just because it's very sensitive to the news. But I think that if it's going to dip or decline, we'll just keep an eye on it. Wealthsimple does allow us to buy this fractionally, so that's going to be a very good thing for us. And we're still eyeing on the watch list, so we still have Intel, still waiting for this to drop. If it doesn't drop, that's fine. We'll just keep adding to our dividend payers. I'm going to focus on POW. We'll watch Alibaba, of course. If it dips, then we're going to throw in some more fractionals in there. So I just started a position here. I can add to it later on. I'm pretty happy with the price that I got in at, but if it goes lower, great. You get a fantastic company at a great price. And because we have a dividend growth portfolio, I'm not really in any duress or any kind of a rush to sell this in a quick time frame to flip for a big gain. This is one I'm going to keep just because I think it has a lot of growth potential, and eventually if the business continues to grow, the stock price should follow eventually. And that goes the other way for businesses that are all built on hype. Say the business doesn't reach its potential, it will fall back to earth. So that's one reason why you want to look at the company, not just buy it because everybody else is buying it. And that's pretty much it for today, everybody. So don't forget to like and subscribe to the channel. And if you haven't already, you can click my link in the description to get the value of 2 free stocks so you can start your own investing journey. All right, have a good day.